Good morning, afternoon, and evening to everyone on the line today with us. Welcome to the webinar on sustainable finance, the next frontier in banking. This session has been organized by Acuity Knowledge Partners, and my name is Daria Rumpf. I'm a director of strategic resource augmentation at the company, and I will be your host and the moderator for today. The topic of ESG is very close to what we do here at Acuity Knowledge Partners, and we chose to unpack this topic now specifically following one of the highly anticipated and, as some critics say, controversial COP29 meeting this year. Quantitative goals and sustainable finance specifically was at the center of discussion. The financial services sector, specifically European banks, continue to be at the forefront of adopting sustainable finance principles to drive the transition to a greener economy. So we chose to speak to the sustainable finance leaders in the banking industry in Europe to get their take on the existing challenges and the exciting path ahead for sustainable finance. In this webinar, we will explore how European banks are integrating sustainable finance into their core operations and the role of ESG-linked credit risk governance, as well as the importance of tracking client transition plans and the challenges and opportunities for the upcoming years in this space. In terms of the structure for the next 60 minutes, we will start with a brief introduction of Acuity Knowledge Partners and our distinguished panelists as well, followed by a TED-style talk by one of our expert speakers as well, and then moving on to the core part of the discussion today, which is the panel discussion, and we will leave some time for the Q&A at the end as well. Please feel free to submit your questions in the Q&A box during the entire session. And also know that this session will be recorded and the link will be published on the Acuity Knowledge Partners website. In terms of the global attendance of this webinar, I'm pleased to report that we have over 165 participants joining us today from various parts of the world, representing over 80 different companies across both sell-side and buy-side firms. And with that, let me move on to take a couple of minutes to introduce Acuity first, before we move on to the topic of the webinar. Acuity Knowledge Partners is the leading provider of financial services outsourcing, being established over 22 years ago. Acuity is private equity owned, with the leading global private equity firm called Permira holding the majority of the shareholding. We serve over 690 financial services firms, ranging from the largest US bulge bracket banks to the leading regional lenders on the sell side, as well as the global traditional and alternative asset managers of all sizes on the buy side. We serve our clients by establishing dedicated teams that work just like an extension of the onshore teams. Today, we have over 6,200 full-time employees across all client groups, arguably the largest pool of analysts and senior associates in the world. Environmental governance and especially social principles are heavily embedded into the DNA of Acuity Knowledge Partners, given the human capital nature of the business. We put strong focus on being the best employer in our core delivery centers across India, Sri Lanka, China, and Costa Rica. And we are extremely proud to be internationally recognized for our achievements. Most recently, Great Place to Work Award in 2023 and 2024, Most Inclusive Employer in 2023, and my personal favorite, the Best Organization for Women in 2023 and 2024. Partners and clients visiting our offices in India and beyond recognize how much effort we put into leading the outsourcing industry by example. The numbers on the slides speak for themselves. As an example, the number of women in leadership increased from 18 to 65 last year. Our diversity, equity, and inclusion network increased the number of events from below 12 to over 60 that we hosted this year. Our CSR Council supported over 30 charity projects with over 1,000 volunteers from the company globally participating. And on the client front, we are very proud to receive the Real Deals ESG Due Diligence Award for our work with private and unlisted companies. In terms of our climate commitments, most recently updated Acuity's Net Zero Roadmap includes commitments to the Science Based Targets Initiative Net Zero standards, for example, transitioning passenger fleet to electric vehicles, and Acuity has also joined the Business Ambition for 1.5 degrees Celsius campaign as well. But more importantly, the ESG principles have been integrated into the day-to-day business operations across all levels of organization, and we feel very privileged to be part of the company like Acuity Knowledge Partners. From the business perspective, one of the key areas that is growing the most in Acuity is our ESG Center of Excellence, led by Achin Bhatti, who is joining us at the panel discussion today. Acuity currently supports about 170 clients with the help of ESG-trained professionals, many of whom are PRI certified or have received external or internal trainings on sustainable finance industry. We support global financial services firms across the entire ESG value chain, as you can see on the slide here today. In terms of ESG public and private research, our clients typically choose to use us for ESG rankings and benchmarking for public companies, ESG KPI tracking for private companies based on industry standard templates, or climate change maturity assessments as well. If we move on to ESG lending space, a lot of times for our clients, we provide SFRD and EU taxonomy disclosure preparations. We help them with the transition pathway assessments for their clients, as well as the ESG adjusted credit risk assessments, including physical risk, which is very challenging. If we talk about the ESG investment banking space, sustainable finance advisory across all sustainable fixed income products is typically where we start with our clients, but it's not limited to that. We also support our clients on framework development as well as peer benchmarking and something a little bit more casual, something like ESG market updates as well. And last but not least, our ESG and data and technology services that we provide. Our brilliant data science engineers and developers are assisting clients with AI-driven technology solutions, especially around ESG data scraping to build standardized reports and dashboards with ESG KPIs. With that, I'm going to move on to the core part of our webinar, and I'm pleased to introduce you to our panelists before moving on to the TED-style talk from our distinguished speaker, Jacomijn Wels, today. So we can start going one by one, and why don't I pass over to Caroline first to introduce herself. Caroline, over to you.
Yes, good afternoon, and thank you very much, Daria and Acuity, for inviting me to join this panel. My name is Caroline Haas. I head up the Climate and ESG Capital Markets business at NatWest. I've been doing this for about 5.5 years, and I have to say it's been really exciting to see how this market has grown. I think, we feel within NatWest that it is core to our strategy and really very much drive out on sustainability with regard to the full proposition. And Daria, do you want me to do the fun fact now or later?
Please do, Caroline, yes.
All right, so the fun fact is that our family is a big skiing family. That's pretty well, we'll spend anywhere between sort of 4 to 5 weeks a year skiing. And I guess the fun fact is that we actually really enjoy also walking up the mountain with our skins and skiing down. So it's not just a one-way direction. And so with that, I have had the pleasure of sleeping in my own self-built igloo, as well as obviously in high mountain huts over, just once we're staying overnight and doing a hut-to-hut trip. Thanks.
Amazing, Caroline. I'm sure it's on the agenda for the Christmas holidays as well. Lovely to hear. Maybe I can pass on to Jacomijn now to introduce herself as well.
Thank you. And similar, very delighted to be part of this panel and part of your webinar overall. My name is Jacomijn Wels. I'm the Global Head of Sustainable Finance at ING. I've been in that role for 2 years, and for me it feels I joined at a phase where the market is rapidly maturing, which is not always easy to stay ahead of, but I enjoy this role very much. After having spent a long time at ING on the commercial side, doing leveraged finance transactions, and on the risk side on credit restructuring. So I'm still learning and very, very honored to be part of this sustainable finance market. Oh yeah, my fun fact. It's not going to be as intriguing as Caroline's, but I really enjoy train travel in Europe, and I do hope that our connectivity will improve radically. But to be honest, I'm going to travel to Barcelona for after Christmas. And my fun fact is that it's actually such a nice way to travel because we have a stopover in Paris. So it actually becomes a whole tour of Europe. So that's kind of my fun fact.
Amazing, Jacomijn, and very ESG friendly. I love that. Of course. And then with that, maybe let me pass over to Everett as well. Everett, please, over to you.
Thanks, Daria. Great to be here. Thanks for having me. My name is Evert Bol. I work at the ABN AMRO Bank, currently in the role of lead the sustainability reporting team of our corporate bank, where we ensure compliance with evolving regulatory frameworks and aligning operations with their sustainability goals. Previously, I served as an implementation lead on the ECB guidelines on SARE, also navigating complex regulatory challenges and driving key compliance initiatives. So I also thought about a fun fact on my end, and the one I came up with: I've always loved French wines. Often visiting wineries in France to pick up some bottles for in the cellar. But when I left my previous job to join the bank's sustainability division, my colleagues had a lot of fun in picking out the gift, and they were all Italian wines, all Italian sustainable wines, and especially no French ones. So that was quite a laugh we had together. Yeah.
Amazing, amazing. Thank you so much, Everett, for sharing as well. And Achin, over to you, including the fun fact, please.
Sure. Thanks, Daria. Thanks, everyone. Hi, my name is Achin Bhati, and lovely to be part of this August audience and panelists. I lead Acuity's ESG Center of Excellence team, which consists of a group of ESG subject matter experts from pretty much all the verticals of Acuity Knowledge Partners, from asset management, banking, private markets, corporates, as well as technology solutions, where we essentially keenly work on the unique challenges which our clients are facing on the ESG side, and we try to solve for them. Sometimes we're able to solve, sometimes we kind of work with the clients to solve them. I also front all the revenue and delivery related discussions with Acuity's asset management clients. Overall, I have 18 years of work experience, and in my last role, I was with MSCI ESG Research as a research production controller. Well, with respect to the fun fact, while I'm stable with ESG, I'm not so stable with the sports, because I'm a sports enthusiast, and I have a kind of tendency to change the sports every 1 year. So I have played tennis, badminton, table tennis, and my last venture is into fencing. So that's it about me. Thanks to you. Bye. Yeah.
Amazing. Thank you so much, Achin, for sharing as well. Well, thank you so much. It's an absolute pleasure to have you all as panelists with us today. I think we can move on to the next part of our webinar for today, which is the TED-style talk from Jakomin. And without any further ado, Jakomin, I'm going to pass over to you.
Thank you so much. And thank you for allowing to give you a bit of an insight in how ING is aiming to finance the transition and how we form our sustainability strategy. So I'd like to take you on a brief journey of the progress we've made on those ambitions over the last years. To give you a bit of an idea how we set our ambitions, how we try and steer our decarbonization targets, and how we have taken that steering from a portfolio steering to a sector level and client steering. And last but not least, we are working on a framework to embed our overall steering on our client engagement in an integrated decision-making process. So first, what is ING's ambition all about? We aim to play a leading role in the sustainable transition. And in order to achieve this, we have, first of all, developed a science-based approach for managing our highest emitting lending portfolios. And next to that, we have set ourselves ambitious engagement targets to engage on sustainable products, whether that is financing the transition to renewable energy, or whether it is the wider set of sustainable products, which classify also on ING's big number, as I think most banks have, are volume mobilized. By the way, we are transparent on how we establish this target and this number. We are transparent about its basis and methodology. This is all disclosed on our ing.com webpage, and we also disclose on this in our annual report. We have a strict reporting protocol around this, And once we review our numbers, we actually also involve our external auditor in order to get a limited assurance before we include it in our quarterly performance update. Next slide, please. If you look where we are, the fundamental journey we took and we are taking is from portfolio steering to client engagement steering on both sides of the equation. So we started in 2018 with developing our Terra approach, and we'll tell you a little bit more about it afterward. It's a science-based pathway that we map for each sector which is considered high emitting. We check annually on these alignments, and we also take into account the alignment when we assess engaging on transactions in those sectors. And that's all to continue to try and steer our portfolio to net zero. Next to the Terra approach, we actually decided in 22 that we should take this steering also to a more individual client steering level. I'm still on the slide before, sorry for that. So we came out with that commitment in 22, and then we actually wanted to do it right. So we took the whole of 23 to develop our methodology and to also go through the process after we validated our methodology to assess our clients' transition plans. And we actually assessed over 2,000 of ING's wholesale banking clients against that methodology. Now this year, 24, we took it to yet another level, and we asked our relationship managers to go out and talk to their clients about our methodology and also about how we assess them and how we assess their transition plans. In actually getting to this methodology, there is a bit of an interesting background, and I think it illustrates how the opportunity side and the risk side are merging more and more in how we get our job done and how we actually steer. We started our commitment from the commercial side. From the sustainable finance expertise, we just wanted to know where our clients stood on their transition plans to help us in the strategic conversations we try and have with them. But once we started to work on the methodology, the questions, the validation, and we discussed it internally, and our risk colleagues actually heard about what we were doing, it turned out that the data we were collecting was actually very important on the steps that our risk colleagues were setting to develop a transition risk steering on modeling, on risk modeling. So of course, when they asked us, can we actually have access to the data that you're collecting? Of course, we said yes. So where this started off as a more commercial tool, it quickly ended up as a tool that is an integrated basis for the wider steering at ING. And that also brings me to the point where we as financial institutions, we need to find the right balance between collecting the data ourselves and actually using consultants for some of the external data that we also need, because it is an ongoing choice we have to make. And we took the choice on the start of the transition plans to actually collect it ourselves. We wanted to actually collect that ourselves, but we also need to make sure that when we collect that data, there's often an independency, and sometimes it actually does make sense to rely on external assistance and reliable data providers and consultants to help us. So that's, I guess, the challenge going forward on where do you collect it yourself and where do you actually need to seek the help from external parties. Then back to the Terra approach, and just to give you on the next slide, the overview of how we report on that. I explained to you that this is the highest emitting sectors that are in our lending portfolio. And we've continued to improve and expand on this approach. We seek the collaboration of others. For this one specifically, we closely work together with RMI's Center for Climate Aligned Finance, and we continue to work on improvements. And examples are that we expanded the geographies that are covered. We also brought in more sectors recently, and we're adding more parts of the value chain within these sectors. Of course, when you look at this graph, and this graph is our most recent annual assessment, you see that not all sectors are green. We, of course, wish we could show all of them on green, But I hope, and I assume, as we all know, we as financial institutions, we finance the real economy, and society is very, very much challenged to stay on track of the 1.5-degree pathway to net zero. And I guess those challenges are also reflected in the RAC status of our sector graphs. We're also delighted to show that we're on track for quite a few and working to actually work the amber and red status to better colors next year. So we continue to improve our strategy, our measuring, and advance our progress. And I hope next year when we actually share this graph that we will also be able to show that progress in the sector pathways. I explained to you on the next slide our client transition plan assessment. It was our next step in 23 to the net zero progress. Why we did this? It's a commitment to our clients, and that's where it started off. We also realized that more and more all our decision making needs to be data driven. It also supports our commitment. It makes it a next step to steer our Terra sectors on our way to net zero. How we did it, we really aligned with external sources like CDP where we could, and we aligned it with methodologies on sustainability reported and standards in the market that are out there as much as we could. When combining that, we actually created a question list, and I'll show you later how that's built up. And then we went through those questions, we verified, and we made them as much yes or no, or really data driven and not qualitative. So they're very quantitative. And then that led us to our internal assessment of how we rate the client transition plans. Important, we relied so far on public data of our clients. So where we could seek it from external sources, we would. If not, we went through every single public sustainability reporting of our 2,000 clients. We assembled that data. We took a proper control to review the data and validate that the data that we store is correct, so that we actually can ensure that we're basing our assessment on the right data. Using public data also has the benefit that it is somewhat a call for action to our clients, because it basically means that we can tell our clients, if you go public on your commitments, we can actually include it in our assessment. The challenge going forward is that we need to continue to work on the assessment. We need to deepen the analysis, and at some point that will have to also include private data. But for now, for this first step, we had various reasons to really base ourselves on the public data available. What does it look like? It's based on 4 pillars, and I hope and assume this will not surprise you. So first of all, we look at the historic emissions, the various scope of emissions. Then we look at the targets that the company has set, the action plans that they have worked around it, and last but not least, how is it embedded in governance and strategy? And that last part is important because this is a continuous effort. This is not something we do once. We are going to repeat this assessment, and the governance is also important to see how it's actually followed up. It's also important to see that targets will turn into actions. If targets remain targets, then that sounds nice on paper, but then it's not a real transition plan. In the middle is a screenshot of what the tool looks like, the dashboard for the people working with it at ING. And the last one is really to show, which is the follow-up we did in 24, that if we have that engagement with our clients on how we see them and the information we have collected, that we also ensure it's all stored and made available on what the conversation with the client was. So that is in a nutshell what we've done up till now. And now in our climate progress update report, which we published earlier this year, we announced, and you can find this information there, that we're taking it to a next level. And this is very much work in progress, but what I can share with you is where we stand right now and the methodology that we are developing. It's our client engagement approach, which is basically stepping up. And it's stepping up to actually continuing to embed the transition plans and the net zero alignment steering in our decision-making process. So we started with the portfolio, science-based, Then we moved to the assessment of the transition plans. And now we're trying to work out a framework, how we can combine the information of both into steering how we can engage with our clients and how we should engage with our clients. This is basically our commitment to continue to develop transparent frameworks on how we guide our decision making. The client engagement approach is very much work in progress. The client transition plan assessment is something we are actually currently working on, how we can actually be transparent about that, because we want to be transparent to make sure that where we can learn from each other as financial institutions. So we are also very keen to learn from others on how they do their client transition plan assessments. And we drive that discussion in institutions like Net Zero Banking Alliance, for instance. The last page that I can show you is basically how that decision tree looks like. The first part of this decision tree is not new. We already had an ESR policy framework in place for quite a while, and we follow that and we continue to follow that. That's more the radical, the very strict limitations on our client engagement. But what is new is that we now actually, for Terra clients, so those clients in the highest emitting sectors, we combine this information to steer, and really specifically in a yes, no, yes, no, yes, no questionnaire on what the implications can be on our client engagement. That's very much to also accelerate the positive engagement, the engagement on sustainable products, but ultimately this will also help us in how we actually prepare those clients that are not aligning with us and not aligning with the net zero transition. And that is where I think going out with this client engagement approach is quite a bold move. And to be honest, it also puts this commitment puts a responsibility on our shoulders to actually follow up on this. So that is absolutely what we're working on. This is basically how we combine portfolio client into client engagement steering. And we're working on making this a fully integrated part of our decision-making process on how we engage with our clients. And that's roughly the snippet that I would like to give you on the approach of ING on steering to net zero and helping our clients towards a more sustainable future. And there's loads more in our climate update report. All of this you will find there, and there's even more detail, but we don't have the time to go into that for now.
Wonderful. Thank you so much, Joachim. That has been super, super insightful. And I especially like the fact that you said that you really are looking forward to be transparent with each other and learn from each other in this industry, because banking a lot of times can be fiercely competitive, but this is probably one common ground that we can all agree on, that sharing here is actually makes a lot of sense. So as we complete this part of the webinar, I think it's now we can move on to the panel discussion, and we will switch up the screen sharing, and I will let the panelists contribute to some of the questions that we prepared. And really, we're going to start with the question looking a little bit forward into the future. You know, we just closed November, and November is part of the year when everyone is sharing their outlooks for 2025. A lot of very smart economists and research analysts has put out theirs. And I would love to start with the question to all of the panelists on what kind of insights into the sustainable finance market do you see as we head into 2025? What excites you and what really makes you not sleep at night? And with that, maybe I can turn first to Caroline to share her insights.
Thank you, Daria. So, you're absolutely right. I think we were all sitting there putting pen to paper and thinking, what does 2025 look like? This year our expectation is we'll be closing out at $1 trillion of, I would say, sustainable finance, which is obviously the labeled green, social, sustainability, as well as sustainable linked products. We expect there's probably going to be about a 6-7%, possibly 10% increase into 2025. So that will take us to maybe about kind of a little over $1 trillion again. we don't foresee that there's going to be a huge shift in the composition of the green, social, and sustainability. Green will continue to dominate, and right now it's just short of about 2/3 of the market. Obviously, that is also on the back of a lot of activity and work and regulations around climate and the environment, which is obviously enabling, I would say, companies as well as the financial institutions to get a much better understanding of their balance sheets and how they would like to fund that. As much as we would like to see more of sustainable linked products, there is still sort of a relatively small sliver of that activity if you look at it broadly. Although when you look at the corporates, it's around 11% of the market. As we get better and more confident, I think, in the value of sustainable linked products as being part of the transition, that is going to be really the trigger of this. And you may have seen recently, there was obviously ICMA that released the sustainable linked loan bond product for financial institutions. And I think that in a way is an enabler, because it sort of has that lovely chain effect to it. So as the banks extend more sustainable linked loans, there is now a sort of use of proceeds product that enables them to finance that activity, whereas it also has a very direct impact on the companies that they bank, and really sort of encouraging that decarbonization. Very much to Giacomine's point earlier, we reflect the UK's real economy. And so that is really where we need to be the enabler and the facilitator to see that UK economy transition come through, and really working with our customers to do that. And I think we're generally feeling that there's going to be an increased spending coming through from the governments. That'll be multiple folds. That won't just be, I would say, the transition, but also very much looking into adaptation. Unfortunately, we are starting to see those events coming through quite clear as more climate change events are happening. And that, unfortunately, will really result in additional adaptation financing that is going to be needed. I think we recently had a bit of a giggle that, people talk about adaptation finance as a new product. This type of project financing has been going on for years. I think we're just sort of obviously now quantifying it in a slightly different direction. I think, as I mentioned, transition finance is huge. And that is where obviously the task in the UK, the task force, or I should say more differently, the transition finance market review really put some really good guidance out for entities to come into and actually follow, and how to now really build out on that. That was on the back of the task force for the I honestly, there's too many acronyms. The Transition Plan Task Force, so TPT, and that is now a very natural evolution of that, so that we should see a little bit more activity there. I think we need to be careful. We should also call out some of the headwinds that we could see. The geopolitical situation right now is challenging, and I'm not just saying it from a political perspective, but also from the kind of defense and military activity that is going on, that will also have an impact on what 2025 looks like. And I think what's important to remember is that all requires energy as well. So, I think we need to sometimes see these in different perspectives. The other piece I think that you've got is the politicization around, and the three famous words, or the three letters, ESG. But I think here we're going to see something else happening, and I think the FT was the first one to call it out, was to call it green hushing. More recently, I've been hearing green whispering, and I think that is probably more to the point. I think the activity will continue. It just won't be reported as much. And so, I think we have some challenges coming through the system, but by no means is this in any way stopping. I have to say we've been particularly encouraged by the private finance activity and what's going on in the infrastructure space.
Great, wonderful. Thank you so much, Caroline. And I'm going to quote one of the teachers in my daughter's school to say that every challenge is an opportunity to grow. So hopefully all of this also, side winds are going to create opportunity, financial opportunity for the banks and the industry overall. Achin, I'm going to turn to you and see if you have anything to add on the topics of kind of the outlook of 2025 as well.
Sure, Daria. I think I would like to kind of sort of points Caroline has already touched upon. So I think from an overall macro trends perspective, what we have seen with a lot of our clients on the asset management and the banking side, what's going to play out really, the driving factors would be the climate change, physical risk, the emergence of private assets, which essentially is increasingly becoming important. Some of the very relevant geopolitical risks are going to play out, and also the elements of the data science or the AI, which essentially is helping to kind of solve many of these ones. So those are the kind of four larger, broader issues which we are seeing. Particularly focusing on some of the nuances of how the sustainable finance markets have been for the past few years. I think we have seen kind of a flattish growth in the sustainable finance issuances for the last 2 years. And what we see this in 2025 is more explained by a normalization of the markets. We have already seen very high growth periods, and these are the normal markets. This is something which the market stabilizes. And what we also see that this will be more driven by quality rather than quantity, wherein we would see more quality issuances, which would be reflected in companies having ambitious climate goals that are backed with interim targets, concrete transition plans, careful choices of eligible projects, optimization of their value chain, disclosure of the KPIs. Some of them would also kind of, by virtue of various regulations, would require to also do third-party assurances and also report it very in a transparent manner. So that's what we are likely to see, which essentially is going to propel the same level of issuances as we move forward. Yes, the innovations, as Caroline mentioned, slight innovations on the sustainable linked bonds and the finances side would continue to kind of happen because they are kind of covering the overall sustainability profile rather than the use of proceeds base. So where some of the trends are kind of already indicating towards some of those newer product offerings and all. That is not what we see in 2025. What we have also seen, largely from a client strategy perspective, and what we have seen is a lot of asset managers and banks are interested in developing scalable solutions, because now we see the markets kind of getting stabilized, normalized to assess these sustainable finance instruments and loans based on their proprietary framework, based on the framework which they are subjected to. Now, this would typically start with developing the framework that reflects their in-house ESG philosophy. Some of them could pick up the various regulations which are there, and then they could build upon that, and then use various kind of data science techniques to kind of use proxy data, impute the regulatory defaults to kind of have some anchor scores. So once that framework is developed, we already seen that some of the clients have kind of deployed, because the thought process is kind of still evolving. They've deployed manual resources to do it, and then kind of gradually transform them into applications, which is a mix of both human as well as automation to kind of automate these workflows. So that's what we are seeing as kind of something which would play out in 2025, Caroline, just to add some additional context to what Caroline mentioned.
Thank you, Achin. Thank you. That's all very helpful and very insightful. Obviously, Achin, from his perspective, he has a very big umbrella style overview over asset managers and banks, given that we support 690 clients overall. So that's super helpful to bring a high level perspective as well. Thank you, Achin. And maybe if we can bring ourselves a little bit down to earth instead of kind of the general outlook. And I'd like to ask you, how are the banks managing credit risk management and the governance from the ESG lens, specifically in your institutions, right? If we talk about NatWest, Caroline, which is one of the largest lenders in the UK, how do you approach that?
So, I think Jacqueline did an amazing job at just articulating how I think we're all working through this. It is exciting. It's interesting. I call it like intellectual curiosity. At the same time, I think we also realize that there are certain gaps and things that we need to just get comfortable with and work through, versus kind of just saying there's no data or this isn't working or whatever. So I think the first port of call, I would say, particularly in the UK, has been climate. and really starting to kind of look very deeply into climate. As we look forward, obviously now with the EU and the regulations, it's very quickly gone into an environmental perspective, or more bringing in the nature components. And then the next piece, and that is already part of the ECB guidance as well, is to take that to social and governance risk. So each of these have quite different components. And I think what's interesting is one can see different organizations having tackled it slightly differently, also from where the geographic location is and where they're based. Definitely the PRA, when we think back in 2019, when they kicked out CBES, was very much to look at climate. And so I'd say that is where we are keeping that is sort of our first port of call. And then that is now evolving into the environmental space. And then with time, that will go into the S and the G. Similarly, I think you're going to see that playing out in the ISSB. So again, we're trying to kind of work the interoperability between what are the regulations in the UK, what is looking more, from a CSRD perspective. And I think this is where, the disclosures are important because it does drive an organization. I think, is sometimes this too detailed on what the reporting requirements are? Probably yes. And maybe in 10 years' time, we'll look back and say, my goodness, look how this has all evolved and changed. But what it does do is drives everybody to those very specific dates where you have to report. And now we're all building the internal infrastructure to actually make this possible and actually make it operationalize it. But at the same time, I think, and I think Jacqueline talked about this very clearly, you need to kind of go through a whole range of different data providers and data itself. I smiled when she said reading 2000 sustainability reports. I definitely understand that very well, and have team members who are not always that happy with me when I say we have to go back to the documents. But it is that, and with that will come, better information. I do have a huge comfort, I think, in CSRD, and not to say that it's perfect in the first go. Don't get me wrong. Don't misunderstand me here. But I think with that, we're going to have a lot more equivalent data and information that we can combine and pull into these data sets. And then, and I think the next piece is, one is the customer engagement, but the other piece that's really important is bringing our colleagues along and really getting them very comfortable, because it is a new way of looking at an entity. I mean, there's a whole lot of different information that is coming together that we now need to make sense of, and then think about how you turn that into a risk appetite perspective.
That's very interesting. Thank you so much, Caroline. And maybe I can turn on to Jacqueline to see if that kind of aligns to your thinking at ING, because ING, of course, is a Dutch bank, but it's also quite global, right? So does that align to how you guys approach things?
Yeah, I can echo so much of what Caroline just mentioned. And indeed, on how does credit risk management and the governance from an ESG lens work, there is quite a broad governance framework from top down, from having an ESG com in our supervisory board to having a senior bank leader sounding board that governs all the decisions and the monitoring and the progress, to an ESG risk framework that applies to the transactions we do and the credit approval related to that. But as Caroline said, most of that is climate mitigation oriented. And that's the reality, where we have this methodology on how we can measure mostly greenhouse gas reductions. And that is also the reason why most of it is climate mitigation. But just like Caroline says, we also realize that the nexus with nature is just there, and that is not something new. That is, everybody who works in this field realizes that. So we are also trying to broaden that scope. But the client engagement approach, our client transition plan, is very much climate mitigation driven by now. But in the background, there's a lot of work to be done to actually make that more nature related. I saw there was a question like, are these transition plans sector specific? As yet, where they are now, they are not sector specific. But once we move to nature, there is no way of escaping to make them sector specific. In January, ING came out with a position paper on nature. And we actually went through our own portfolio and we mapped where nature is the most relevant. Then 4 sectors for us came out as like in a heat map. So that's just when you move to nature, you inevitably move to a region and sector specific approach. And that's a challenge that makes it a lot more challenging to actually develop a methodology that you can actually have validated and consistently go out. But we are totally on that same path. And also adding to the point that Caroline said, it's not just about the group of experts in the bank anymore. We also made a conscious choice on this client transition plan to ask our relationship managers to go talk to their clients. We offered our support if they needed, but we tried to get them to take it on their shoulders and just go out. And we felt we gave them tools, we gave them training, gave them templates, and still we initially had a lot of reluctance to go and talk. Not so much because they don't want to talk, it's just that it's so overwhelming. I'm in this business now for 2 years and I can still get intimidated by the alphabet soup. So it's no surprise that relationship managers need help, but it's essential and vital if we want to deal with the data and we're becoming more and more data driven, that we deal with this as an institution as a whole and not as a small expert group.
Great. Thank you so much, Jacomin. Very, very fruitful conversation that we're having here today. And thank you so much for those of you who are submitting the questions on the Q&A box. Please keep them coming. We're going to address some of them at the end of the session, and some of them maybe we'll answer on email as well. As a side note as well, we're going to run a poll question now, just to see on the engagement from our participants on the webinar, and your take on the challenges. So if you don't mind taking 1 minute of your time to reading through the question and picking the answer that feels best approachable for you, that would be much appreciated. And we can, in the meantime, move on to our third question on the panel. And I wanted to talk a little bit about the best practices to consider while drafting the ESG lending framework more specifically. So how do you guys balance the profitability and sustainability goals within your organization, right? Because this is one of the tricky questions and the elephant in the room that is present among the entire industry. Maybe, Jacomin, if you don't mind commenting on the ING approach with that.
Yeah, I'll try, but as you say, in many ways, it's the elephant in the room. And it's the one thing where, you know, as an industry and how we engage and the products that we have at hand to drive the transition, the modeling behind what we do and the modeling behind sustainability and ESG risk is also very much maturing. So balancing profitability and sustainability goals today is not that straightforward. We're starting to develop models to actually guide our appetite, our risk appetite, and how we can actually steer that to also make sure we allocate the capital we have to those clients that transition with us. But it's far from perfect. And I would be surprised if any financial institution says, yeah, we have the perfect models to steer. But we're working on it. So it's not a direct steering. I think we steer a little bit more indirect, but we also have to be careful because the technologies we need to finance, a lot of them are not mature technologies. So there is a limit to how far you can stretch your risk appetite to actually stay within your framework. And that's not only to our shareholders, but it's also just as much to our regulators who are, you know, keeping a close eye on the risk that we take on our balance sheet and whether that is still defendable from not introducing any undue risk in the financial system. So we are developing tools. We don't necessarily take concessions on profitability, but it's work in progress. It's not maybe the elephant in the room, but it's very much work in progress.
Thank you, Jacomin. Yeah, it's very counterintuitive, right, this question, because in theory you don't want your clients to be paying premiums on being not green, not sustainable, not aligned with their client transition plans, but you have to make them do that. Maybe Achin, I don't know if you have your take on overall kind of conversations that you have with your buy side and sell side clients.
Yes, Daria, of course. I think what we have seen specifically with the largest sector of clients is banks, asset managers who started their integration journeys either on the lending side or on the investment side have been able to kind of make steady progress because they would have kind of tried one or more strategies which have not worked. And specifically focusing from a bank's perspective, we have seen that largely banks are taking two approaches. They're either taking the portfolio decarbonization approach or maybe the financing the transition of a high emitters towards low carbon business models. That is where essentially all of us need to move to. Now, to achieve this, basically, as Yokumin already mentioned, there's a lot of data already being collected on climate transition pathways, where the gaps are. And when this is being done, what we have seen is it also brings on new opportunities in the form of transition finance, or maybe the need for an advisory solutions for a particular portfolio company or a borrower. And that is where I think we see it would kind of bring in more business, as well as in the process of kind of achieving some of these CTP goals, we'll be able to kind of, the banks would be able to kind of achieve both profitability as well as create more opportunities for some of these products per se. Of course, this has to be done, as Yokumin rightly mentioned, within the realms of the risk appetite and all. But yeah, within the overall risk appetite, these are some of the other newer areas where we have seen banks have benefited by kind of either embarking on those CTP plans, either through transition finance or through advisory solutions. Basically, and because we are catering to a lot of financial sector players, we have seen these are the kind of larger trends which essentially would come and kind of help the banks. And the results, of course, on the transition finance and on the advisory solutions are mixed, but I think those are the areas where some strides, some progress has happened basically.
Thank you, Achin. Thank you. That's very helpful as well to understand. And maybe we can move on then to the next topic, which is never becoming easy. Every year it's becoming more and more difficult and challenging, which is around the ESG reporting and what the regulators are asking of you guys, sometimes fair, sometimes unfair, and how AI can drive and help with some of those challenges around the reporting. And with that, Everett, this is absolutely your turf. I would love to hear your take as well on the ESG reporting side and how you guys at ABN AMRO utilize the AI technologies today.
Thanks, Daria. High expectations, always good. I would say the beauty of the topic connected to AI is also that you can easily ask any large language model this question and get a fair insight in an answer and the challenges on the topic. So with the risk of echoing things like ChatGPT is providing us, I think the challenges and complexity is within the volume, of course. So especially looking at banks, we need to manage large volumes of data, also fragmented sources. So that's like internal data, self-collected data, scraped data by the models, also from third-party vendors. So I think that's one challenge to start off with, but also the inconsistency and lack of standardization. So that makes it really difficult to compare metrics also across entities or different geographies. And data gaps already touched upon by Caroline and Jacomine as well. There will be significant gaps in data, for example, concerning social and governance. I think metrics that are less quantifiable instead of looking at environmental. And not to forget, like the regulatory compliance, evolving standards. Yes, we are maturing, but still regulatory requirements for ESG reporting are evolving as well. And it's challenging to keep up with new guidelines. And maybe a third one I was thinking about is the stakeholder expectation. So there is a need for transparency and also accountability, but that also creates an increasing pressure from stakeholders, investors, also customers, for transparency on ESG practices. And not the least, also our internal stakeholders could also be challenging. There are high expectations for readily available data, but also challenges with acquisition of data. So sometimes it sounds like a great opportunity to buy some data and use it, but it's almost never a one-stop shop towards the answer. Well, at least in my opinion. And maybe to make the step towards how AI can assist us, I was thinking on the natural language processing, which is a branch within AI, where algorithms can scan and gather data from multiple sources, such as annual reports or ESG reports. And that data we can, for example, use looking at our NFRD or EU taxonomy activities. I think that's a really great step forward, also looking towards 2025 in how we can make a difference using AI for all our reporting purposes, internally, also externally. But I'm also curious how Caroline and Jacomine look at this topic.
Caroline, maybe over to you and how you approach this at NatWest.
Yeah, no, thank you. I have to say AI was sort of our second biggest theme for 2025. We find it actually incredibly interesting. You know, as we start to think about, and I'll just take it back to climate and environmental, physical and transition risk, there are 4 sort of segments that now need to be analyzed on a sectoral basis on an entity level. And that's a huge amount of information that we need to kind of work our way through and understand what is the actual inherent risk associated with that sector, with the credit, where is it based? And AI can help us tremendously with that. And I think, you know, we're already starting to see some of the tools that are coming out, and the speed at which that information can now be assessed is so much quicker than anything that we've been able to use up until this point. So it will help the long-term decision making just a lot easier. We'll be able to do different simulations. We'll be able to turn it in a different way, and then be much more agile around how to then turn that into the business opportunity piece or into the risk loss avoidance piece. So I'll stop there just to make sure we get in Jaco's comment as well.
Yeah, sure. And indeed, Caroline, you were smiling when I spoke about 2,000 clients. And it probably is more than 2,000 sustainability reports, because not every client, some clients have more than one. But how we got about that in 2023 was manual. And that was painful. But we felt we had to do it. And this is where I think LLM is where there is a perfect role for LLM in the future to make our lives a lot easier. The whole verification of the data, of course, still needs the human eye. But at ING, we're also looking in the possibilities of Gen AI, and we basically see a lot of opportunity with the notion that we also need to use it responsibly. Let's also take the sustainability element into account when we talk to or when we turn to Gen AI, because it's raising a large energy need, but there is a cost benefit opportunity there. And yeah, I'm really hopeful that we can get to the core of the information that we need to make the assessment, and that we can really use Gen AI to make our lives a lot easier to work our way through all the sustainability reporting of our clients, which is only going to increase by CSRD, which I basically see not just as a challenge, I really see it as an opportunity to be more integrated and get better aligned data of all the companies that we engage with.
Thank you, Jacomine. And I love that you finished on this positive note. I really hope that it's going to be 2025. Maybe potentially it will spill into 2026, but at least we're talking about very good progress along the natural language model and large language models that we have. And with that, maybe let me host the second polling question that we have for our joiners today on the webinar. For those of you who are still online, thank you so much. And please do address the second polling question that we have around the focus area for growth, specifically in the sustainable finance goals for the next 12 months. It would be highly appreciated if you can pick one option that is more suitable for your team and for your firm, and we will take a note of that for sure. We have one last question that I wanted to address, which I think really trying to round our session for today, and we're spilling over a little bit in terms of time, but I wanted to round up on a positive note to talk a little bit about the opportunities within sustainable finance and what is the most attractive and makes you really excited as we speak about 2025 and beyond. And Caroline, if you don't mind, I will turn over to you again to comment on what you're excited most about.
You know, there's so many things to be excited about, actually. I have to say, I see this very positively. I think, you know, and it's topics that we need to get into. I addressed them earlier: adaptation, nature, really moving out on transition finance, right? I mean, we're talking it, but it isn't yet really flowing. And I think I was talking to one of our peers, and interestingly, I think in some ways Asia is a little bit further ahead of us than actually Europe is on transition finance, and just seeing how to mobilize that in an organization, and that actually creates a lot of excitement. I think for me, it's also, you know, I was at COP in Baku and seeing Article 6 kind of come and land, that we can actually start to move forward on the carbon markets, because I see the carbon markets really does also have a added value of being able to solve some of that. How do you get finance into the quote unquote global south and really help them also solve some of their problems? So I think there's some things that are now being enabled that will move us forward. I do think one thing we really have to do really well as the SMEs is really take us back to basics, in the sense of showing the financial materiality of why this is important, and that it's either revenue generating, because I mean the amount of activity in the infra space is off the charts, or looking at it, the loss mitigation. And I think if we can get that message through, then we really pull everybody else. And, you know, I don't have to say it on this call, have knock-on benefits that are really into the real economy.
That's great. And thank you so much, Caroline. I feel like I can align to a lot of what you said as well. And I don't know if, Everett, if you have anything to add here, because I think for 2025 planning, ABN AMRO has a lot that you have on the board in terms of your planning and aspirations for 2025. Anything particular that you're excited about? I can give you a hint that I know that you're excited about the AI, but I'm not going to put words in your mouth.
No, I will not use AI. I'm really fan of the collaboration. So the thing Jacomijn is mentioning already, like the cooperation and collaboration between banks, I really like that part. So I look forward in making it better and stronger together. So that's where I'm looking forward to in 25.
Great. Well, thank you so much, Everett. Thank you, Jacomijn. Thank you, Caroline and Achin. I think that has been a very, very productive and personally for me, very informative panel discussion together with the TED Talk that Jacomijn kindly gave to us as well. Thank you for your time. We're going to move on to the results of the polling questions from our participants on the webinar today, just to see what the people were voting about. So if you don't mind putting out the answers, here we are. So the first questions that we asked to our audience today was, please indicate one key challenge that you're facing in achieving the net zero and sustainable finance goals in your lending or investment portfolio. And by the looks of it, it looks like availability of data to measure and track performance is still leading. And I wonder if there is an element of private companies versus public companies in there, but we take it as the leading answer. And the second one is aligning business goals with sustainability goals, which is exactly what we were discussing today. Of course, that does remain the elephant in the room. And maybe we can move on to the second polling question as well and see the results there. And the second question we asked to our audience was the focus area for growth. To achieve your net zero and sustainable finance goals, what is one area that you're keen to develop in the next 12 months? And kind of overwhelmingly, really, invest in in-house solutions, data models, and technology was picked by a majority of our respondents, which is pretty much in line with what the conversations that I have globally with the banks, but also on the buy side, I think we hear the same. And the second answer running is the thick third-party help to build frameworks, remediate data, and build technology. So a lot of data and technology conversations, which is exactly how really Acuity is engaged with a lot of our clients today and where we help and come in. And we have a couple of questions.
The combination will elevate your credibility. So I think we have all a need to not just rely on external parties and build in-house, but the credibility of your framework is enhanced if you seek the help of external parties to build those frameworks.
100%, Jacqueline. And we have a couple of questions that were submitted on the box, Q&A box today. Thank you so much for submitting them. We picked one question, and I will turn to our panelists. Best advice to a smaller retail and commercial bank who are looking to implement their first sustainable finance framework to highlight existing activities and further internationalize future lending. So I don't know, Jacqueline, Caroline, Evert, Achin, who wants to take that question? Best advice to the smaller retail and commercial bank.
It's not an easy question to ask, also because that's not the perspective where I sit from. So who am I to give the best advice to a smaller retail and commercial bank? Although I do have colleagues who might be able to answer that question. So whoever asks the question, maybe I can connect them. But I think don't overcomplicate it if you're in a smaller retail side of it, but also stick to keeping standards. And I think that's almost impossible. But for that part of the market, if you're going to overcomplicate it, then you're not making the change. So that's, I think, the dilemma to manage well.
And what I would add to it is just see it as a joint effort between the front office and the treasury function, so that it actually is a really kind of tied together piece.
Absolutely, Caroline. And Everett, anything to add on the best advice for the smaller retail and commercial bank?
I think a lot has been said already, so not really. Keep it simple. I like that.
Absolutely. And from my side, if I can be humble enough to give an advice, I think retail and commercial banks are talking a lot about the kind of the number volumes of business. So if you can make the best use of AI and tooling and whatever is necessary to make this machine running as quickly and efficiently as possible, I think that would be amazing if you can make that work. Well, thank you so much. We're going to take the rest of the questions offline. I'd like to thank our panelists, Jacqueline, Everett, Achin, Caroline. Thank you so much for spending 1 hour and even more with me today to unpack some of the very important topics globally today. Thank you so much to our audience who joined us. It was absolute pleasure to also get your questions on the box with us today. Thank you to the team who helped organize. There is a big marketing team at Acuity who are sitting behind the scenes, helping the machine running and doing everything smoothly. And please feel free to reach out to some of the key contacts on the screen today, myself, Johan, and Karthik, with any questions, any follow-ups, or if you found anything interesting and you want to connect. Thank you so much. With that, we're going to wrap up and have a wonderful afternoon and an enjoyable break.
Thanks so much.
Thank you. Bye-bye.
Thank you. Bye.
Bye.
Bye.